Good morning, everyone. I'd like to call the meeting to order. We have a full agenda this morning and starting a little early. There'll be a couple people who will be late, but we'll get started anyway. So would you please call the roll?
Ms. Avila Farias. Mr. Schaefer for Mr. Chung. Ms. Gallagher. Ms. Gunn for Dr. Imbasiani.
Here.
Mr. Gunning.
Here.
Mr. Hunter.
Here.
Ms. Johnson Hall.
Here.
Mr. Metcalf. Mr. Prince.
I am here.
Mr. Williams for Ms. Podesta.
Here.
Ms. Sotelo. Mr. Russell. Ms. Boatman Patterson.
Here.
Ms. Ortega.
Here.
Ms. Falk.
Here.
We have a quorum.
Thank you. I would like to just remind the board that since we are being recorded, and the only way that people can review the minutes is if they search for somebody's name, that you please raise your hand and ask to be recognized so I can call your name, and that way it'll be on the tape. So I appreciate that. So the next item is the approval of the minutes of January 17th, 2017. Can I have a motion to approve?
So moved.
Ms. Gunn moves to approve, second.
I'll second it.
Mr. Gunning, seconds. Can you call the roll, please?
Ms. Avila Farias. Mr. Schaefer for Mr. Chung. Ms. Gallagher.
Aye.
Ms. Gunn.
Aye.
Mr. Gunning.
Yes.
Mr. Hunter.
Aye.
Ms. Johnson Hall.
Aye.
Mr. Metcalf. Mr. Prince.
Yes.
Mr. Williams.
Yes.
Ms. Sotelo. Mr. Russell.
Aye.
Ms. Falk.
Aye.
The motion, or the minutes are approved.
Thank you. Item number 3 is a report or comments from the executive director. Ms. Boatman Patterson?
We had a lovely retreat last night, and it was nice to have some policy discussion. One of the things I did not do is I did not give you the dates of the upcoming NCSHA, and I thought I had those with me, which I was hoping to provide, but I do not. So what I will do is I will make sure to email you all of the upcoming NCSHA, the Housing Credit Conference, the annual conference, and I'll get those dates for 2017 out to you all via email.
That's it. Okay, thank you. We'll move on to now item number 4, which is the discussion recommendation of possible action for final loan commitments for the Rancho Carrillo apartments. Mr. Surdich?
Good morning, Board. It's nice to see you bright and early again this morning. Everyone got a good night rest after our brief discussion last night. So I will kick it off a little bit with a brief introduction about the 2 projects that we are bringing to the Board for approval tonight. The projects have a lot of similarities. They both are under our permanent refinance loan program, where they are not resyndicating on tax credits. They both have had tax credits on them, but and they've reached their 15-year point, and they're looking to refinance their loan. As part of that, they are paying off their existing Cal HFA loan with a yield maintenance payment. They both are reducing their rates significantly, and we are getting new affordability agreements on the new extended affordability agreements on the project. Both of these projects are also, at least on their face, taking equity out of the project. It's a little complicated because they also both were sold in 2012 from the original borrower, the original CalHFA borrower, to the existing borrower that is now refinancing the loan. And as what I'm going to do now is I'm going to turn it over to Steve Lyerly, who will discuss each loan, and then we'll open it up for questions.
Good morning. My name's Steve Lyerly, loan officer with Cal HFA. Do we have, wrong project.
No.
So the first loan we're going to discuss this morning is for Rancho Carrillo Apartments. It's in Carlsbad. It's northern San Diego County. The amount of the loan is $13,650,000. This is 116 units. It's all family. It was originally developed as part of an inclusionary housing obligation to open up a master plan community down there for single-family development. And the master developers met their inclusionary housing requirements by approving this multifamily site, and that's how it was originally built. Has two affordability agreements from Carlsbad. One is dealing with the a land use for the inclusionary housing obligation, so there's some underlying restrictions there for the development to meet that obligation. The second one is they made a loan on the property of $1,160,000, and there's some of their own regulatory requirements for that also. So the property is actually restricted at a blend of 50, 60, and then 80% of AMI, with all the different overlapping with Cal HFA's regulatory agreement of 20% at 50, and then those that are on there for the city of Carlsbad. With this loan, the agency will be receiving 8 additional years of affordability. And I need to call out on page 2 of the report, under 16, there's a typo, misinformation here. We said at least until 2041. It's actually into 2037, so it'll be a 20 years minimum extended from 2017, which is actually 8 additional years from what their current affordability restrictions would expire. And do we have, I want to show you a little bit about this property. I don't know what slide we're on. This is, well, this is a typical courtyard view. It's done kind of in a, it's all stucco tile roofs. It's a little bit, the site is not flat. Carlsbad is a little hilly. It's a couple miles in from the coast here. So that's just a typical look with the patios. That's a nice pool deck and pool and community room. Leasing office is adjacent to it, and that is the community room, and that is a playground for the kids. This is pretty fast. And this was just kind of a typical kitchen on the right, ADA kitchens on the left. We asked for some additional ADA improvements on this property, and we made them adaptable rather than hard like this. So if you look on the left, you'll see the hard ADA units. It's very hard to market the property because there's not the ADA units that we visited. Nobody was disabled. They were in there for the affordability. Sometimes developers and owners have to make concessions. It depends on what the market strength is, because they have things like open counters under the sinks and lower cabinets and less cabinets. And you'll see on the stove controls will be on the front as opposed to be in the back. But on the front, kids can get to them on the front, right? But on the back, it's harder for the littlest kids. Usually by the time they can reach the back of the stove, they've learned. So I think the developer's going to pull some equity out of this. It's basically to return what they put into it when they bought the property together with about $1,117,118 is going to pay off the remainder of the Carlsbad loan. Also, a representative of the developer, USA Properties, Mr. Darren Bobrowski, is with us today. And well, on, oh, well, yeah, there's the improvements on this property are basically just to make some ADA improvements and a couple of path of travel improvements. There's some erosion on some of the walkways because of the hilly deal and causes some path of travel issues, some uplifting from some routes. But other than that, it's pristine condition, as you see from the slides, and we've had 2 different P&A providers out there, physical needs assessments. One was hired by the agency and another that was hired by the developer, and there's no dispute over the condition of the property.
Are there any questions of the board on this property?
Are there, yes, questions, Mr. Prince?
I just, can you talk about what happens to the yield interest payment?
Sure.
I know it has nothing to do with the
Yes,
development.
no,
but
no,
it struck
the-
me as an interesting idea.
The yield maintenance payment, really what that is doing is that is making up for, before 2006, all Cal HFA multifamily loans had a no prepayment clause in them. The loan was not prepayable. What we have done with our loan prepayment policy is we said you can prepay, but you must make up the difference, the expected spread to Cal HFA over the existing life of the remaining loan. So we then take that money and we put it into the to the bond indenture where that loan was funded from. Hopefully that allows us to retire bonds earlier and generate more cash for the agency to then put back into our programs and use as subsidies and other projects as necessary.
Thanks, sorry. I should have asked about the project, but I was curious about that topic.
Mr. Hunter?
A quick question, on it. The amount being paid out to restore the city's trust fund, is that over and above the 5.6 million equity that the owner is taking out?
Yes, it is.
Other questions? I have a couple. The city regulatory agreement is being paid off. I mean, the city loan is being paid off. Does their regulatory agreement stay in place?
Yes, it does.
So their restrictions stay in place
they
for the
do.
full term?
Yes.
Okay. And I know I've asked this before and I keep forgetting, so remind me about if our loan is prepaid.
Yes.
Does our regulatory agreement stay on?
We have a minimum agreement that the regulatory agreement must be at least 20 years or 5 years additional to our existing regulatory agreement. In this case, our existing regulatory agreement is only on for 12 more years. So our regulatory agreement will be on for at least 20 years or as long as our loan's outstanding.
Okay, so if they prepay, we
They'll
have
still
at least
be,
20
yeah,
years?
correct.
Okay. And I know I've also asked this question before, and what is our policy on how much equity can be taken out?
We don't have a limit on how much equity we can take out. What we do, we put some controls around our if a project wants to take equity out under our permanent refinance loan program, we will reduce the LTV on the project so that it's a sliding scale, but generally we can go up to 90%. We will reduce it down towards, in most cases, around 80% LTV. We also have, in this case, we required more ADA accessibility to be added to get up to the 10% TCAC, current TCAC levels, whereas back when this was done, it was a 5% level. And we also make sure that our affordability is extended, as we talked about. So that's currently our policy on to that regard.
Okay, great. Well, I think it's really good that we're doing these kinds of loans so that these properties stay in our portfolio.
Yeah, and one other thing I
have
want to.
extended affordability.
Yeah, one other thing I want to add, not only we're extending affordability, obviously, we are making some revenue on the new loan as well, that we will then be able to roll in, because there's no new subsidy going into these deals. So, there's no new tax credits, no state subsidy, no local subsidies going into these deals. The revenue that we are making off the loan is pretty much free and clear, and we'll be able to roll that into new programs as necessary.
Ms. Boatman Patterson?
I also want to note that they're paying off the subordinate debt, so that's money that will be returned to local government so that they can continue to finance more affordable housing.
Mr. Prince?
So on page, I think it's page 15, so the current replacement reserve is over 200,000, but then the cash into the new reserve is only 116,000, so why reduce replacement reserves?
Well, they're going to use, those replacement reserves are going to be used to do the immediate needs.
Okay, sorry if I,
No, that's a good question. So there will be.
Right, so the
some of it-
112 is going to come out of that. The additional, it will come up, is our minimum standard is $1,000 a unit for the replacement reserves. Under, of that immediate needs, actually 43,000 of that is just a TCAC requirement for the first 2 years to be held in reserve of expected needs over that time. And so that's how that's determined. Again, the reserve study, and you look at the property and the needs coming up at different times on the property, that's how that's all comes together, and the property's in excellent shape. As you saw, it's, tile roofs that don't need replaced, stucco exteriors that don't need anything, and the owners, USA Properties maintain and manage their properties extremely well, and they take care of everything. And when we were first able to go out and look at this, they had signs out. The original P&A requirement was for they thought they should resurface the parking lot. And when we went out with the construction inspection, the P&A inspectors, they had signs up everywhere. They were letting the tenants know that they were getting ready to reseal and restripe and the parking facilities, and that was done, and so it was taken off the list because it's redundant. So they're very, it's also, it's a fairly dry locale and not really many issues, so it's really pristine.
Are there any other questions? Ms. Sotelo? Yes.
I'm so sorry to be late. We had a little hiccup at the hotel. I just wanted to ask staff about the replacement reserve for the project.
We just,
Oh, did you already go through that?
but you should ask it again, just, I think it's a good
Well, I just want to understand depleting the reserve and then refunding the reserve and how that works, and just tell me the logic behind that. And if that's not prescriptive, can we change that within the underwriting criteria?
Well, sure. So there's a, maybe I'll go just a little deeper.
Well,
On-
I think I understand the concept of what you're doing and how you're using
Yeah,
it, but it
okay,
doesn't make
so-
sense from an underwriting standpoint to use the reserve as a source and then to
Well, but
refund.
there are improvements being made.
Right, but so our loan can be used for those improvements as a source.
Yeah, what the.
But there's no, well, excuse me, but, so the physical needs study, which we have 2 of them, show what the repair needs and the replacement needs are over time. Okay? So the facilities are in great condition.
Right.
And we start off with, at this point, with $1,000 a unit. Okay? So we wouldn't add any more if if it all came out. That wasn't the intent. What happens with this owner is that in their maintenance budgets, in their property budgets that they submit to us, and the audits that I've seen from prior years, is they're spending $800 per unit per year on maintenance, okay? Because they are so proactive. So the reserves are really for the big ticket items, something that is going to be, 100,000 or 50,000 or something, that we want to make sure that the money's there at that time, like if they need to paint or, re-roof or replace windows or something to that extent.
I think that, so I do understand what a replacement reserve is for, so I
Okay.
appreciate
No.
the explanation. But I think my question is a little bit more fundamental in terms of the underwriting. So the only source of money to the project, Tony, is our loan and the replacement reserve. So all I'm suggesting and all I'm asking, I guess, is from an underwriting perspective, is there a reason that we need a non-CalHFA resource to be contributed to the project, like the replacement reserve deposit that's already in place, towards the development costs? Can't we just say our loan is going to be used towards all those improvements that we're doing? Because
And leave
it's
the
both a
replacement reserve
source
in
and a
place.
use, and it
Yeah, I mean,
doesn't.
I think the idea here is that, and I completely understand what you're saying.
Okay.
And I think we have a pretty standard formula about how we deal with this stuff. And what we're
Okay.
looking at is the existing loan is going away, the existing replacement reserve is generally going away, and then we're starting fresh with a new reserve study, with a new physical needs assessment, and seeing what the property needs going forward. But I do understand where you're coming from, and I think on this one, and going forward, we would definitely take that into
Yeah,
account.
I would, again, just suggest that staff take a look at it from a perspective of, it doesn't make a lot of sense to me to have it be both a source and a use within the same development budget.
Okay,
And when it comes to reserves, the other issue is that the Section 8 certificates that are, you're not underwriting to the Section 8 certificates on the project right now, right, because they're not project-based?
Correct.
So should the Section 8 certificates go away for those individuals that have certificates and are being used, is there a way to set up a reserve that you can calculate the ability to transition them into the higher paying rent that you anticipate and that you're underwriting to, especially given that they're 30% AMI folks? So it's not like a traditional transitional reserve that you would have in a Section 8. And I hate to kind of get micro on this, but the reality is that you have Section 8 tenants, you've had Section 8 tenants for a while in that property. They're not project-based, but the reality is if their vouchers go away, which I think might be a reality given the federal
14% cut.
forecasting, then can we set up from the equity proceeds being received by the developer, can we set up a transition reserve to help mitigate any potential drop in incomes for those individuals?
Yeah, and I do think that a lot of those Section 8 tenants are being counted at the 50% restricted rents now and not the 80% restricted rents. So in a lot of cases, that just increases the cash flow to the project. But if they do go away and they only can pay, 20, 30% rents, then that would be a struggle in that regard. I agree.
Right.
That's something we could talk through with the developer and see. But I think at this point, setting up a reserve probably is it's a little late in the game to do that. But we could talk about setting aside cash flow to make that happen.
Okay,
I mean-
I don't understand why it would be too late, given that we're about to approve the loan.
I agree.
And that we're
I
the
agree.
only
I
source of
spoke
funding on the project.
incorrectly there, correct.
So,
Yes.
I would just, Tia, if we could just take a look at what the size of that reserve could potentially be, and to see whether or not it would be prudent to set that aside from the equity proceeds of the developer.
So I think the last time we did something similar to this, Delilah, it was it 18 months? Do you remember?
It was a transition reserve that was for 12 months.
12 months, okay.
To allow the resident, who would likely be getting 30% of median income, to be able to transition
Right.
into the higher rent.
And so I think on that particular project, it was a project-based Section 8.
Correct.
It wasn't individual vouchers.
Right.
And I do believe, correct me if I'm wrong, but this project is underwritten as if they were paying 50% AMI.
There's
underwritten
50%, 60%, and 80%
Okay.
rents in here. Like I said, I imagine most of the voucher recipients who can earn up to 50% are underwritten at the 50%.
Right. And so Delilah, what we will do is we will both look at the cash flow and the equity takeout and have a conversation with the developer. But we are pretty far along in the process, having negotiated the terms, but we will commit to having that conversation.
Okay, great.
Yeah, Ms. Johnson Hall?
So, the building is now, it was built in 1999. You showed some beautiful pictures of the project. The one thing I do know about that replacement reserve is that it's, like you said, it's for the big ticket items, the roof, the things like that. So are you saying, you mentioned the P&A, but I didn't hear what was actually in the P&A. So did the P&A say that the roof has another 20 years of useful life? Is that what it said?
We
Yeah,
get a
tile
20
roof is actually a lifetime roof or 50 years for a P&A standard.
Okay, I don't know what's in it. You didn't say.
The P&A, we
So-
do a full 20-year P&A that looks at appliances, exterior, interior. It looks at everything, the
Okay.
needs over the next 20 years,
Okay.
and determines how much needs to be set aside to meet all of those needs over the next 20 years.
Well, and if I could say maybe an analogy, when they purchased a property in 2012, think of like purchasing your own personal residence, everybody fixes up to sell. And when you're a buyer, you ask for some things that you want done or an allowance to get them done. So they didn't buy a fixer-upper
Mhm.
in 2012. They bought a pristine property. Okay, it had been well-maintained up to that point. There were the last permit drawn on this was in 2012 to do rehab on it. It was minor rehab, but it was for some rehab. So, we're at a point where there has been, systems replaced. And this deal they had replaced a couple of years ago. They replaced, reading the audit. I read all of the audits,
Yes.
and I read their proposed budgets for the ongoing forward years. Okay, so I think it's about 2 years ago on Rancho Carrillo, they have all individual water heaters. Well, they replaced them all. Well, that is a big budget item. Oftentimes they do them, when they go out or something. Well, they have great buying power. They own thousands of units. They get a good deal on water heaters, and they're starting to see systematic failures, and they decide to go in and replace them all at that time. So they're a very proactive owner, and I think they should be rewarded for being very proactive also.
I'm not, USA Properties has a stellar history in affordable housing. No one is questioning that. I think what I am specifically concerned about is whether we have, as my colleague Delilah has so eloquently stated, we have reduced the required reserve, and we're now putting another 40 years' worth of loan on this. I just want to make sure that we could get to that term without having to revisit the required replacement reserves. And I want to understand what your underwriting and thought process was around that.
And that initial reserve is there, and there will be an additional $400 per unit per year being added to that reserve over time as well.
That's, okay, thank you.
that
Th-
we're
That's where I
adding
was
more
going. I'm
over
trying to
time.
understand what the thought process is. I'm not questioning the developer or anything like that. I just want to
Yeah,
understand what
that-
the staff's thought is around that.
They're currently paying about $303 a month,
Okay.
so we're raised it to $400 a month. So there will be
So
adequate
you've sort of done the
reserves from-
analysis to say in 10 years, this is what it could look like, and we believe that the dollars that we'll have at that time will be sufficient. And as a backup, if it's not, then are you saying that we have the ability to tell them, hey, guys, we need you to step it up?
Yes.
Awesome.
Mr. Prince?
Yes, so I think it's been a really interesting and thoughtful conversation. I mean, I think we have 5 cares. We care about the assets, the reserve thing. I want to come back to that. We really do care about the residents. I probably should have started with that. We care about the local jurisdiction getting some money back to do more housing. We care about College FA's financial strength, which is really important. And of course, we care about the owner. So all of those things are kind of competing. And so I find it interesting. For example, the idea of pulling cash out, I think might make some of us nervous, but the owner could just sell to someone else and would get the cash anyway, right? So I think at some level, keeping a good owner in place is the right thing. Going back to the reserve thing, I do think that there's ways, whether it's the transition reserve, thinking about those voucher holders who are there. The budget is really pretty scary, 14% cut. We heard yesterday. I know they're protecting tenant payments right now for 2018, but who knows where that goes? It's projected 100,000 people are going to lose housing, 15,000 in California. Just by the 5% cut that happened in 2017. So I totally agree with you that it is, we need to protect those families and make sure that the owner doesn't get in a spot where they either have to terminate families and add to the problem. So there are ways to do the reserve where it could be for 5 years and then paid to the owner or something like that. I think $400 a month might be a little bit low. I'm sorry, it's $400 per unit per year. So you said per month. Got it in my head.
I'm sorry.
That's all right. So I do think the reserve conversation is an important one to have. I don't think that there's a way that we should change it at this time. I know you said we still are voting, so that's true. We do have the right to vote no. But I do think that all of those concerns are ones that have raised that should be looked at and really thought about. I do think that there might be a way to do as I said, a structure the reserve in a way that and to tell you the truth, every deal we do in Fresno, we have a transition reserve. We have reserves that get paid back to us that are held for 3 or 5 years that come to us after performance has been met. So I think that those kinds of ideas are good ones that should not be like rejected by an owner outright based upon the benefits that they're getting from a great 40-year mortgage.
Understood. I was just following up to see if we knew how many tenant-based vouchers were on the project, and we'll look into that.
Oh, so
Yeah,
I think
it's a
that's
big-
great.
Yeah, it's a relatively big number, so that is very important, especially in a high-cost area like Carlsbad. We can't afford to lose.
Is it in the report? Because I didn't. see
No,
it.
no.
The amount isn't, but the fact that there are.
Yeah.
But yeah, we don't think, the developer didn't think there were significant vouchers, but we will look into that and see how many there are and see how we need to, if we need to set aside a reserve for that.
That way it's a small reserve.
Yes, yeah, I think we'll see.
Or maybe we should ask for more voucher holders to be let.
No, well, I'll keep them under control.
Are there any other comments or questions? So we have a resolution in the packet. Can I hear a motion for approval?
I'll move, Madam Chairman.
Mr. Gunning moves to approve. A second.
I'll second.
Mr. Prince, call the roll, please.
Ms. Abala Farias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Gunning?
Yes.
Mr. Hunter?
Yes.
Ms. Johnson Hall?
Yes.
Mr. Metcalf? Mr. Prince?
Yes.
Mr. Williams?
Yes.
Ms. Sotelo?
Yes.
Mr. Russell?
Aye.
Ms. Falk?
Yes.
Resolution 1705 passes.
Thank you. We'll move on now to the next project, which is Parkside Glen.
I'm back.
Mr. Lilly?
Parkside Glen is in the city of San Jose. It's just behind, off Capitol Expressway, just kind of behind the Auto Mall area there, if any of you are familiar with the city of San Jose. Here's a overhead picture of the site. It's about 7.5 acres. It's 180 units. It's family. There are 3-story buildings, all walk up. We are providing a loan of $34 million for this property. The standards for it are pretty strong. There's a loan to value of 57%, and there's a debt coverage ratio of 1.32. So our loan to value can go up to 90%, and our debt coverage ratio can go down to 1.15. So these kind of reflect a little bit of the sizing, because there is a sizable equity out on this of 23 million. JRK Properties purchased this from the Related Companies of California in 2012 also. And the immediate needs on this property are 3,500. Relatively low, I understand that, but the property is that clean and looks that good, shows that well. Here's a picture of some of the exteriors of the pool. They have a kiddie pool and a full swimming pool, a clubhouse, obviously. That's an indoor playroom on the right for the kids on bad weather, and that's one of the community rooms. That's a typical kitchen. And these were the immediate needs, primarily. We had a broken light that's now been fixed, that shows on the entryway monument. There was some fascia board on one of the carports had come loose, and the P&A consultants had determined that the laundry rooms needed lever faucets rather than the twist because of some hand things. There's a couple of items, restriping a couple of
You mean ADA?
handicap, ADA,
ADA.
yes, and another ADA unit in one of the carports. The carport wasn't actually striped for ADA. Yeah, there's two P&As on this property. One that's provided for Partner Engineering, who represented us, and they had one from UES Consultant. There was no dispute between the P&As. Yeah, the affordability on this is 50 and 60% of affordability. And the city of San Jose had an original loan of this with Related when what was the original loan amount? It was $5 million. Do I have it on there?
Yes.
Yeah. Original loan amount of $5,130,000. JRK Properties is the owner of this property now. They purchased the property from the Related Companies. In that transaction, the city note was paid off at that time. The city, in order to allow for, with their regulatory agreement and subordinate, and to allow for us to come back into a first lien position, and with the developer and with the equity out, is providing for an additional 10 years of affordability on their own. And this is full affordability because their regulatory agreement covers the 50% and the 60%. So all but the manager's units are restricted. And so this is a true 10-year extension of affordability. And Calif J's will be extended for an additional 8 years over today, or 20 years from today, essentially.
Are there questions?
So,
Ms. Sotelo?
yes, thank you very much, Stephen, for the presentation. Just a couple of questions. Do you know the purchase price from Related Companies that JRK paid back in 2012?
I do not.
No, okay. And let me just understand the affordability. Under the staff report, it shows that the tax credit regulatory agreement expires in 2029.
Correct.
The City of San Jose agreement is till 2054?
Yes,
Is
it
that
was a
the
55-year
case?
agreement.
Okay.
In this
And
case,
then-
TCAC at that time was 30-year agreement, so that's why it's in 29.
Yes, yeah. And then our Cal HFA agreement will be until 2037?
Correct.
Okay, so we are basically getting an additional 12 years of affordability with, can you explain the 8 additional years that you calculated in your staff report? How do we get?
It has
what's
an
the
existing
total
12 years,
affordability?
so it was to have expired, and so we have either 5 years or a minimum of 20. So 5 years would have taken us to
Yeah, on our policy, we either do 5 additional years of affordability from our current regulatory agreement. The minimum is either 5 years plus our current or 20 years, but the affordability will last as long as our loan is outstanding as well. So we are, on this loan, since there's 12 existing years on our current regulatory agreement, we will put a minimum of 20 on the project. But if the loan stays out past 20 years, our affordability restrictions will stay on the property until our loan is paid off.
Until the loan is paid off?
Correct.
Okay. So potentially, if there was no prepayment on the loan, when would our covenants expire?
They would expire in 2057.
Okay, so the city of San Jose expires in 2054. If our loan is not paid off, the covenants stay in place until 2057
On our loan, correct.
on our
Yes.
loan. And then I have just 2 more questions. One is on the yield maintenance. Can you talk to the board about the yield maintenance and how that's all set up?
Sure. Yeah,
I'm sorry, did we ask this?
that's okay, I'll go through it one more time.
I think you're so smart, you're asking the right question.
Yeah, 'cause you already asked it, right?
So prior to 2006, all Cal HFA loans had a lockout on prepayment for the life of the loan. A few years ago, I think maybe when we were, let's say the late 2008, 2009, somewhere in there, we opened up a prepayment policy where we allowed loans to prepay. However, we required the borrower, as part of the prepayment, to make up our lost income earnings that was expected on the existing loan. So the yield maintenance is based off of that. That money will flow back through the bond indenture, wherever that loan is held within the agency, and ultimately come out and be used to fund new programs.
Okay, great. And then the last is, do we have the developer here?
Yes.
Do you mind actually just coming up? I just want to hear a little bit about the developer and your intents on the property, if you're keeping it long-term, or, if you're going to, as part of the equity payout, just kind of what your general plans are around the equity payout.
Yeah, absolutely.
Introduce yourself.
Introduce
So
yourself.
on the radio, it's Alex Lowe with JRK Properties.
Great.
Alex
thank you.
Lowe at JRK Property Holdings. I'm JRK's Chief Investment Officer. Appreciate the opportunity to be here and the opportunity to continue our partnership with Cal HFA. JRK's been around for about 26 years. We've had a pretty sizable affordable housing portfolio, as well as conventional housing. And our plan here is to be with this property for the long term. So when we bought it, our plan was to hold it for 20, 30 years. We don't plan on going anywhere. We like the stable nature of affordable housing and obviously the good that it provides to the community. The equity out at our plan is, and our goal is to expand our affordable housing portfolio. So we'll be taking that equity and doing what we can to try to find other opportunities to expand that moving forward.
Great. Okay, thank you.
Are there any other questions? I would just like to,
So I'm just kind of curious, do you get?
Mr. Prince,
Yeah,
we
sorry,
need to get your name on the record, so.
Do you get tax benefits if you reinvest in properties? I mean, is it like, do you do like when you pull that cash out, I'm just kind of curious, what happens to it? I mean, it's a pretty large number, so it's like, I like it that you're saying you're going to reinvest in more housing, but, I mean, are there huge tax consequences initially, or are you able to protect it a little bit as you invest back in? Can you do, what's the right term for the exchange? The 1031?
So there are opportunities to exchange back into properties, but we have investors, that this money will go back to those
Okay.
investors, but have been with us for a long time, and they are looking to reinvest with us. So we go back to that same investor pool and then go and try to find other properties and create the same type of investment. And there's a natural cycle through things. We have both individual syndications on properties where we will go to those investors on an investment, and we also have private equity funds that we also invest with. This is just an individual syndication, which is why we're in this for the long term. In our private equity funds, those typically have a 7 to 10 year hold. When we do an individual syndication like what we have here, we typically try to stay in it for as long as possible. We're long-term owners and holders of real estate.
Okay, thank you, thanks.
Madam Chair, one of the.
Ms. Sotelo?
Thank you. one of the, I think, for me, the broader conversation around this program, which I love, I think it's a very robust program, and I think staff has done an excellent job in terms of rolling it out, and actually wish, we had more developers actually using it, a lot more nonprofit developers using it. I'd really like to see that. But maybe one of the things that we can talk about in a future agenda item, certainly not today, is the idea of utilizing our partnership with these developers. The fact that we have been, their lender for the last 20 years, and we're about to be their lender for another 30 to 40 years. Whether we could actually utilize our partnership role to also benefit from the increase in equity on properties like this. Localities like Carlsbad are an important partner in the fact that they are going to be getting repaid, and that money that's being repaid is going to go back to the development of affordable housing. But is there a way that we can, from a policy perspective, share in the equity upside on a property such as this or the Carlsbad property, to then reinvest in our own programs like we were talking about during our retreat yesterday? So I just, again, not for discussion today, but in a future
Right.
agenda item.
Yeah, I do want to say that we have to be careful in this program that we balance out what we're asking of developers versus what they can get in the marketplace. Because, I mean, one of the what we have asked for, when we came up with this program, what we asked for was extended affordability. Otherwise, a developer could go to a private lender and take out as much as they want, So if we make it too onerous, we're not going to keep the projects. So it's a real balancing act that we have to do. And I'm really glad that projects like this are staying in the portfolio.
So can I
Mr.
ask
Prince?
the owner, so I was asked by my mayor if the city could participate in equity participation in real estate deals done by the housing authority, and I stammered, right? So, I mean, private sector, would you ever think about public participation and equity participation? Yeah, so that's the look I thought. That's the look I gave my mayor, so.
You're putting me on the spot there, but we're always looking for, potential partners, and that's something that we'd be happy to discuss.
I think it's an interesting concept,
That's a
so.
whole nother,
Yeah.
step, but absolutely, it's something we should explore.
Okay. Ms. Johnson Hall?
I would this is just a little direction to the staff. I think this reads to me like a new construction project. And it's, when you're working on a rehab project, in my mind, we really have to have a little bit more focus on what happens after the project is completed and stabilized. So in this case, you don't have to really worry about stabilization, because everybody that's in there is basically going to stay there, right? That we think. I don't think people are going to move out when they get a brand.
They don't even know this is happening.
They won't even know what's happening, right? So I think that when I look at this, what I'm trying to understand, and it's not clear on the face of what you've provided here, is how long, what we've done to ensure that over the life of our loan, this project is going to be around and available. I don't really I don't really see in what you've presented, the results of the P&A as an example. The fact that you've looked at 3 years of operations and determined that $400 per month is adequate. I'm just making up numbers here. And I think we just I personally need to understand that a little bit better when I'm making these decisions, so that I have a little bit more assurity around us looking at these projects long-term as opposed to, making a fee on it, which to me is important, but really not as important as the longevities of these projects going forward.
I agree, and we updated this write-up last year, and it's
Yeah.
a moving target, so we appreciate the feedback, and we'll make sure that gets in there.
Ms. Boatman Patterson?
So I want to let the board know, too, that on all of our projects, we require a P&A, and it's a minimum 20-year P&A. And so that is a requirement as part of our underwriting, and we take in these applications. So that may not be being expressed, which we will work on and make sure that that is, but that is an absolute requirement that we're getting on all of our loans, is that we're getting a physical needs assessment.
Yeah, see, that's the thing, I'm sorry, Madam Chair.
Ms.
But that's
Johnson
what I
Hall.
think is important for the record, to understand that we have in fact done our homework, that we have looked at that, and we're looking out overall for the project.
I have to say that, you know, I was actually more startled by the 3,500 requirement, total requirement on improvements than I was by the equity, because I've never seen a project that's that big and that old with so little rehab. So could you just, and we've talked about this, but could you just explain a little bit about the condition of the property and why it's so low?
Why the requirements are so low?
Why
The rehab
the
needs.
only,
The rehab
that
needs is-
$3,500 is all that needs to be done?
Well, when I walked the property with one of the P&A, with our P&A provider, Partner Engineering, the maintenance guy was out there, and he had been there for like 15 or 16 years. So they have continuity. The office manager had been there prior to, had been there during the related term. And before that, it was, no, it was just related on this one. And so there was continuity in the project in terms of who they saw, the front face in the leasing office, the managers that they talked to, and with the maintenance people. And the pride of that maintenance man for that property was, you know, it was just evident. You know, he was embarrassed by these things. That's why there's $3,500 worth of improvements. And that, I believe, is typical of the people that they put in place in their management team.
Along those lines, the developer also was using a lot of the cash flow in the budget to do the repairs on a regular basis. So I know a lot of tax credit projects that we see, they defer the maintenance for a larger resyndication to increase basis and to get that done. This developer, as more of a market rate developer, was seeing it more as just a project that needed to be repaired as necessary. The $3,500 did surprise us as well, and we did our double due diligence to make sure that that was all
Well, that's to
good.
be commended that the property is in such great shape. And maybe just to help the board, given the questions that have been asked, you could just say a little bit about what our asset management does as we go on through time
Sure.
to make sure that things stay in good shape?
Yeah, I mean, so we inspect our properties at least every other year, if not every year. We have 4 in-house inspectors in the asset management group. So they go out there regularly and give the properties a list of immediate repairs that need to be done for health and safety concerns. They look at short repairs that have a little longer lead time, but that need to be done, and then they also note any sort of longer-term issues that should be reviewed on an ongoing basis next time we inspect and should be monitored. So that's really the inspection part of our asset management. Our asset management group also reviews the audit on an annual basis and ensures the compliance of the property on a regular basis. Sometimes we can find some of those maintenance issues through the review of the audit as well. If not enough money is being spent, or if a lot of money is being spent, there may be issues with the property. So there's a number of things that our asset management does, but it's a very strong group of asset managers that we have, and I think Cali Chaffee is known for our strong asset management of our properties, which is why our, getting to some of the points that were made earlier, our historic default rate is amazingly low. We've had losses on 2 properties in the history of Cali Chaffee, dollar losses, and one of them was during a construction period. So only one of them had ever reached our asset management group with any losses. So it's a very strong group, and we take a lot of pride in that.
Thank you. Mr. Russell, I think you had a question?
Well, I really appreciate the line of discussion here, and would look forward to bringing that back at a future date. Ms. Sotelo, in particular, I think some of the key principal questions you're asking are important. But unless there's material questions about the project, I'd like, maybe we could call the question on this.
I just have one.
Ms.
one other
Sotelo?
piece. Just again, the same comment here on the Section 8. There's about $500,000 of income from Section 8 certificate holders. So again, looking at that is an important component. And then the replacement reserve conversation again. I think we just have to maybe take a look at it from an underwriting standpoint in terms of how we're using that.
Ms. Gallagher?
Yeah, I had a question, not specific to this loan, so it doesn't have to delay the vote necessarily, but it's more on to the point that was raised earlier about the federal, potential cuts to, for further cuts to federal housing assistance and the impact that has. And to some extent, I'm more curious about how the, owners of this look at this and, how are people bracing for this in their budgets? And I don't want to derail this conversation, but it's something that, at some point I'd have a follow-up conversation with some folks offline.
Okay.
Okay.
So I'd be happy to,
Mr.
at the
Prince?
next meeting, talking about what housing authorities are doing, because there was lots of conversations about what's happening with Section 8 cuts, so I'd be happy to do that at the next board meeting. And then the last thing I just have to say, I think that Ms. Johnson Hall brings up a really valid point. I mean, if you're doing the same 1,000 per unit, capitalized, $400 per year per unit, it doesn't have the appearance that's necessarily matching up with the P&A. And so I think that there should be a little bit more work that shows that it's not just taking certain rules and just applying them. And then I know that HCD and CalHFA must have real data about what happens to properties and reserves. I think these are in high-cost areas and have revenue to cover losses. I would probably have a lot more concern if these were in the valley, and so I would be not as confident and comfortable. So I just want to bring that up as a policy issue.
A couple quick responses to that. One is, not all of our projects are $1,000 and $400 per year per unit. We've gone up to $600 per unit, per year, per unit. So we do vary that based off the P&A. These two properties were they just happen to be very similar in a lot of different ways. And then the second step, we have begun reviewing our historical replacement reserve draws we do have a robust over 500 properties that we administer in our asset management group. So we've been reviewing that. We have some new data tools, some new staff that have a very good handle on data analysis. And we are looking at our historical averages regionally, different loan or project types, so we can do a better analysis of what we would expect before we even get the P&A on the replacement reserves.
Thank you. Well, I think we've had a
I
call
will
for the
move for
question,
approval. Yeah.
please. So is there a motion?
I so moved.
Mr. Prince, second. Mr. Russell? Call the vote, please.
Ms. Abala Farias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Gunning?
Yes.
Mr. Hunter?
Yes.
Ms. Johnson Hall?
Yes.
Mr. Metcalf?
Yes.
Mr. Prince?
Yes.
Mr. Williams?
Yes.
Ms. Sotelo?
I'm abstaining.
Mr. Russell?
Aye.
Ms. Falk?
Yes.
Resolution 1706 passes.
Thank you.
Thank you.
Now we'll move to item 5, which is discussion, recommendation, and possible action regarding the adoption of a resolution authorizing the agency's single-family bond indentures, the issuance of single-family bonds, short-term credit facilities for homeownership, and related financial agreements and contracts. It's Mr. Sue.
Good morning. I think once again, I feel like I'm that relief pitcher coming in after the fireworks, doing the easy job. So every year we come in front of the board asking the board for authority to fund the financing activities for the entire following calendar year. A lot of stuff that we do is on a fiscal year, but this particular activity is on a calendar year plus 3 months of the following year. As a group, agenda items 5 through 9 are 5 resolutions that are the annual resolutions that we bring to the board for consideration and authorization. And together, they provide the authorization for staff to do all the financing activities that the board actually approves in our business plan in May. So we tend to do this one ahead just so that May is not as busy, but what we have here does incorporate many of the things that we are talking about in the business plan. So first, we'll go through the two financing resolutions for single family. So we have a bond resolution, a non-bond resolution, and we can talk about that a little bit more. And we have a similar sort of coupling for multifamily, bond and non-bond, and then we have a resolution for SILAC authorization. So Resolution 1707. As I mentioned earlier, this particular resolution, along with the following resolutions we have, they are more or less on a calendar year. It provides staff authorization to do certain financings for the remainder of 2017 and for the first 3 months of 2018 until the board meets until the board meets in March of next year. I'm not going to go through everything that's in this resolution. I'm just going to highlight a couple of things that has come up in the last 3 or 4 years. For new money bond issuances, we're restricted to issuing bonds for only MBSs. As the board knows, that's primarily the activities that we're engaged in right now. And the the financing could only be for fixed rate bonds, and that means no variable rate bonds and no swaps. There's also a section of refunding. I'll just highlight that for refunding, it states that we cannot refund fixed rate bonds into variable bonds. Is one of the limitations that we have. Section 3 also has a lot of associated documents that's related to issuance of bonds, and in it also has a section on how much credit facilities we can get. And this particular provision is tied to the multifamily side. So right now it has a limit of $500 million. So as the board knows, we have currently a $100 million credit facility from Federal Home Loan Bank of San Francisco we're using right now. So we're well under that for now. I'll pause and take any questions that you might have on this resolution.
Are there any, Ms. Johnson Hall?
Just a quick question, Tim. The 60 days, is that a policy or regulatory? I mean, it seems short to me.
So what we're doing there is just in case for some reason the board doesn't meet.
Well, that's exactly why I asked the question, because when I looked at the board calendar, we were almost every other month. So I thought that maybe you might ask for 90 days as opposed to 60 days, just to give you that extra time, just in case one of our meetings gets canceled for whatever reason.
That's a great idea. Well, part of the reason why we do the 60 versus 90 is that we don't, we're trying to be cognizant of not overstretching our authority from the board. But if the board would entertain 90 days, I can certainly do that next year.
Well, we do have, this year, we set up, tentative meetings every month, just in
Got it.
case we needed to do that.
Mhm.
And if we continue that policy, we might not need to, we could always have the meeting on that day that's the tentative day.
So that we
So,
don't-
which is every 30 days, so I
think we're
think we're okay.
okay.
So there's one thing that I kind of gloss over. About 2 years ago, we started, more than 2 years ago, we used to only have one resolution for single family and one for multifamily. One that's bonds related for single family and another that's bonds related for multifamily. About 2 years ago, we started taking to the board this non-bond resolution, which is the next resolution. And the reason why we did that is that the board now knows that most of our financing activities actually are not done through the issuance of bonds, which is how we primarily did our lending business prior to the financial crisis, if you will. So now, we, as you know, in 2016, on single-family side, we did close to $1.7 billion of lending without issuing a single mortgage revenue bond to finance the activity. So we felt that it was better for us to continue this tradition of requesting the board for a bond resolution, but at the same time to annually come back to the board for authority to do all these other things that we do and not rely on a resolution that we passed, let's say, 6 years ago, they gave us permission to do, for example, these mortgage-backed securities that we're doing right now. So that every year we'll come back to the board on these non-bonds, which are in parallel with the bonds, but we bring it to the board every year so that the board is reminded of all the things that we're doing. So this one is the bond side, and my handicap is that this year we will definitely use some of the refunding provisions in this particular resolution to help us continue to deleverage our balance sheet, but I'm not sure if we'll end up using any of the new money authority in terms of issuing bonds to finance our lending activities.
Are there any other questions? May I have a motion? Mr. Hunter?
I'll move adoption of Resolution 1707.
Ms. Tina Hall?
I'll second.
That was with,
I
I
think
think
it's
it's
with
with
the
60
60
days
days.
with what's in there, yes.
60 days.
Yes.
60 days, okay for now.
Call the roll, please.
Ms. Abala Farias,
Yes.
Mr. Schaefer,
Yes.
Ms. Gallagher,
Abstain.
Ms. Gunn,
Yes.
Mr. Gunning,
Yes.
Mr. Hunter,
Yes.
Ms. Johnson Hall,
Yes.
Mr. Metcalf,
Yes.
Mr. Prince,
Yes.
Mr. Williams,
Yes.
Ms. Sotelo,
Yes.
Mr. Russell,
Aye.
Ms. Falk.
Yes.
Resolution 1707 passes.
Okay, we'll move on to item 6, which is the non-bond, single-family non-bond funding.
So this is the resolution that provides authority for staff to do all the mortgage-backed securities lendings that we're doing now. I very much try to avoid this phrase that we introduced to the board many years ago, that this particular model is called TBA, which stands for to be announced, which means nothing, really. But it is a mechanism in which we lend using the GSE guidelines under a conforming model in which we're lending and we're selling the loans to the mortgage-backed security market. So this particular resolution is sort of divided up in two parts. The first part talks about the authority that staff is granted by the board to do all this mortgage-backed security lending. It does not provide a limitation, and that's in part because we expect there sometimes could be an upside, and that the board would be pleased with an upside. So, for example, in 2016, we did nearly $1.7 billion of lending through this mortgage-backed security model, and the year prior, we did nearly $730 million, which is a lot as well. But when compared to $1.7 billion, it doesn't seem like very much. So we think that a model in which we really are not really tapping our capital to lend is one in which if the board would grant us that authority, that does not really require a limit, because this particular lending model really is not capital constrained. The only one is the one we talked about last night, in which the single-family lending is very highly dependent on this down payment assistance pot of money that we have from the state. So the second part of this resolution is tied to something that we talked about last night as well, is that it talks about using our unencumbered cash, and later on I have a chart to show all these uses. At some point last night, Tia talked about, Tim is going to show a chart on cash that was reserved for today. And the second part of this resolution talks about how much of our cash, how much of our, you might say that is equity, is money that's not encumbered by the bond indentures or any financial obligations we have, how much of our cash we want to dedicate to certain programs that the board has authorized in the past. So the first item is the board last year under Resolution 1612 authorized not to exceed limit of $5 million for this Roberti 710 program. So we haven't forgotten about that, and it's still something that is in the works. And so we have set aside $5 million for that. So then, again, the second part of this resolution speaks to all these programs that we have authorized in the past that at some point the money might go out. And the other one that's that received a lot of allocation this year is this help program that we talked about resurrecting last night. The help program to support ADUs for the locals. So there is a set aside of $20 million for the help program, which could also be used for funding of subordinate loans if needed. So together, we're setting aside $25 million of our equity for these special programs.
Are there any questions? Ms. Sotelo?
I'm sorry about that. What is the thought of how long we will have these programs in place, or how long are we going to set aside this money for, the $25 million? Like if we don't, with the Roberti piece, the $5 million, we haven't really used that, and yet we've had that set aside now for about a year, right? So when do we start checking in to see whether or not we're going to utilize these funds?
That's a good question. I don't think we ever put a time, sort of like an expiration date on some of these program allocations. I think that we're expecting the 710 program to produce some loans, but I think that, jump in, Tia, that I think that our expectation is ever so underwhelmed. So I expect that in the next couple, my handicap is that if we don't get any loans in the next couple of years, we should think about whether or not to sort of unallocate those dollars.
So would staff have a recommendation, Tia, as to when we should sunset the HELP ADU program for the $20 million?
What we can do is since we revisit this on an annual basis and we're coming back annually, we can do it, we'll continue to come back and ask. And so I think that'll be our check-in, is that on an annual basis, we'll let you know what kind of progress we're making. Like, we're not making a whole lot of, we're underwhelmed, as Tim says, on the whole Roberti Act. So and can you correct me, but is the Roberti $5 million within that $25 million?
Yes.
Or is it in addition to?
So it's 5 for Roberti and 20 for HELP.
Right. And so it's up to that amount, and what we can do is commit every year. We'll come back and report to, because we consider that like our special initiatives, some of the stuff we talked about last night. And so that's our pot of money to help implement special initiatives. And we will, during the mid-year report to you on our progress, and then on an annual basis, when we come and ask for that amount, we'll do a check-in with you.
Okay. And I guess just maybe to, Madam Chair, to just put it on our radar, I would feel comfortable if we amended the resolution to say, that the money's available for the next 2 years, for sure. And then, again, the annual check-in, we can modify that to either extend it or to terminate the programs, I guess, if they're not working. For me, I think it's just more important that if we're going to set aside $25 million of our program income for innovative programs, that that innovation happen within 2 years, and that programmatically we use it within 2 years. And if we don't, let's recycle and come up with more innovation and different projects. But that's just my recommendation to the board.
Other comments? Ms. Johnson Hall?
I guess I'm a little bit confused. I thought that the money goes into a special initiative pot, and then we decide, and then the staff makes recommendations on how that gets used periodically. Is that accurate, or is it different?
It doesn't really go into a special pot. It's
Okay.
more like we have a big pot, and we're
Okay.
saying we want to spend up to this amount of our big pot on these special programs. And we come back every year and ask you how
What-
to spend our money. So I don't know if saying this goes out for 2 years kind of throws us off track. I'd have to defer to our finance director.
He's here today.
Put on your other hat.
Tom has a good point that we're not explicit. I know this is the word I chose, and this is where I'm getting spanked by my English teacher. We're not explicitly setting aside the money. This is really a not to exceed dollar amount. That's how it's stated in the resolution.
Okay.
So it's,
Okay. Yeah, and I think that to the degree that the board is comfortable, that's part of the reason why we decided to bring this to the board every year. Like suppose that if we were requesting the board for a resolution for help for ADU, and we said we're only going to do that once and not revisit every year, then I think putting a time frame in definitely makes sense. But this is all sort of wrapped in this idea that we will take this back to the board, or bring this back to the board next March. And if we don't use it, the board should definitely chime in on.
Ms.
I know-
Boatman Patterson?
I don't know if all the board recollects, but in 2011, there was a Bureau of State Audits report that we weren't being as open and transparent with our board members, because sometimes we would have a resolution that happened 6 years ago that gave us authority to do something, and then we would just go out and do it. And so what we have really tried to do is on an annual basis with these financing resolutions and separating out this financing resolutions is to be very open and transparent with our board and to do a check-in. So if you don't want us to use up to $25 million on an annual basis for innovation programs, then you can reduce that amount, you can increase that amount. But we do not only an annual check-in to get the authorization, we also do a mid-year report where we check in with you on a mid-year basis and tell you what progress we've made.
Okay, we ready for a motion? Mr. Shaver?
I just want to confirm something that Tim has heard me ask before. I want to be clear about. Once the delegated authority becomes effective, everybody is happy at the staff level that we have appropriate internal controls to make sure that that doesn't get away from us before we reauthorize this next year. Is that correct?
That is correct.
Thank you.
Okay, Ms. Johnson Hall?
I move to approve Resolution 1708.
Thank you. Second?
I second.
Mr. Russell.
Second.
You want to third it?
Ms. Avila Farias,
Yes.
Mr. Schaefer,
Yes.
Ms. Gallagher,
Yes.
Ms. Gunn,
Aye.
Mr. Gunning,
Aye.
Mr. Hunter,
Yes.
Ms. Johnson Hall,
Yes.
Mr. Medcalf,
Yes.
Mr. Prince,
Yes.
Mr. Williams,
Yes.
Ms. Sotelo,
yes.
Mr. Russell,
Aye.
Ms. Falk.
Yes.
Resolution 1708 passes.
Okay, now item 7 is now moving to the multifamily side for first the bond resolution, and then item 8 will be the non-bond sources. Mr. Sue?
So, Resolution 1709 covers the bond issuance under the multifamily side of the house. So this is constructed similarly to the single-family resolution. This goes out 60 days beyond the next March board meeting. And we have a similar restriction here that for the new money bonds, we can only issue fixed-rate bonds, no variable rate bonds, and no swaps. And this year, Tia asked me to highlight this as something that we eliminated. We eliminated a certain loan level insurance requirement that we once had. So the reason why we did this is that over time, as we try to accommodate all sorts of financings that come into CalHFA, we've noticed that the different insurances that we look at, they present their own costs and benefits. So as the board knows that one of the key tools that we use today in our lending program on the multifamily side is this HUD risk share program that we have as an HFA. So when we have risk share wrapped around the loan, there are certain things that kind of come into the equation. So Davis-Bacon comes into the equation, and if we're doing ag rehab and also construction loans, sometimes prevailing wage comes into the equation. And there are times in which, when we're trying to accommodate the project, that perhaps getting a short-term loan from a bank that does not have all those attachments, if you will, and have us come in as a permanent financing, could help the project get done. So last year, what we did with this provision is that we softened it to say that we may use risk share and or similar sort of insurance, and we feel that to sort of be open and sort of and transparent and sort of just tell the board what really we are actually doing, is that we are, as you know, primarily using the risk share insurance to wrap around our permanent lending. There are times in which do agri-hab lending too, and it's all under this umbrella of HUD risk share. But there are times in which the conversations with the developers could be a little bit more fluid if we didn't always have to think that we're using risk share for everything that we do. And that's why we eliminated this provision to have what I refer to as a loan level insurance requirement. And the last bit of this resolution, which mirrors the single-family side, as I said, this is an attachment point between the two resolutions, that the single-family side and multi-family side together could have a limit of $500 million in terms of the credit facilities we can get. As we mentioned, we have now a $100 million credit facility with Federal Home Bank of San Francisco. We started a dialogue in the last month or so to expand, if you will, expand the eligible collateral under that credit facility. Right now, we can only use single-family MBSs, and we're asking them to consider taking these multi-family risk share loans that we're making as a possible collateral as well. And part of the reason for that, I'll come to on the next resolution, is that there's a need to warehouse those risk share loans for a week or so, for about a week to 2 weeks, between the real estate closing of the loan and the funding from FFB.
Okay, are there any questions? We have a motion to approve.
Make a motion to approve.
Ms. Sotelo,
I make a motion to
Yeah.
approve resolution number
1709.
1709.
And the second from Mr. Hunter.
Yes, second.
Call the
Ms.
roll, please.
Ms. Abala Rios,
Yes.
Mr. Schaefer,
Yes.
Ms. Gallagher,
Abstain.
Ms. Gunn, Mr. Gunning, Mr. Hunter,
Yes.
Ms. Johnson Hall,
Yes.
Mr. Metcalf,
Yes.
Mr. Prince,
Yes.
Mr. Williams,
Yes.
Ms. Sotelo,
Yes.
Mr. Russell,
Aye.
Ms. Falk.
Yes.
Resolution 1709 is approved.
Thank you. Move to item 8, which is the multifamily financing resolution for non-bond sources.
So this resolution is much like the single-family loan bond, is broken up into 2 sections. The first section provides authority to do all these non-bond financings that we're doing. So primarily what we're doing now is using the HUD risk share with HFAs as again, this is my nomenclature, as the loan level insurance. And then we close the real estate on that, and within a week or 2, we're then getting funding from FFB to pay us back. We're effectively selling that loan to FFB. As I mentioned, and the second part of this is that we're setting aside $50 million to warehouse. I'm sorry. Let me stop using the word set aside. We're putting a not to exceed dollar amount of $75 million to warehouse this particular lending activity. So as I mentioned that the logistics of doing the lock and getting funding from FFB, that when we get close to the end, there's some inability on their part to change the day of the closing if you have provided certain notices. So the way we're mitigating that risk is by closing the real estate first with our own money, and then providing some of the final notices to FFB so that FFB can have their funding. So that way, we are making sure that the real estate closes, and we're sort of making sure that the funding by FFB is fairly tied to the actual real estate closing. If we don't do it that way, it's quite possible that the whole transaction could delay by a couple months, I believe. So we're setting aside where we have a not to exceed amount of $75 million for this warehousing activity. I'll come back later. There's a chart I have to show how all these dollars are sort of stacking up with the amount of unencumbered cash that we have.
Are there any questions? Ms. Sotelo?
What is the risk that there is no funding after we close on the real estate side? And we're left with having funded out of our own money?
I think the risk at this point is minimal. As I understand it, and Tia and Tony can jump in, as I understand it, that there is a MOU between HUD and FFB, the Federal Financing Bank, which is the lending arm of U.S. Treasury. There is a MOU between HUD and FFB for this program to run for 3 years. So I believe it's 3 years means 9/30/2019. Is that correct? So I'm confident that if we're requesting for funding prior to that date, that we will get funded.
And with projects like the one that we just saw where the closing is a $34 million loan, what does that do in terms of the $75 million that is being not set aside, but whatever the term would be, that's not set aside?
That's why, as I mentioned, that's why we started this conversation with the Federal Home Loan Bank of San Francisco to request that they take these kind of loans as eligible security. Sometime last year, I forgot when it was exactly in terms of timing, we actually had warehoused about $30 million of loans with our own money. And there were a couple other things happening at the time too that made me think that, not that we were close to sort of spending all the cash we have, but it was making me sort of thinking, oh, you know what, this would be a good idea to expand our credit facility with Federal Home Loan Bank so that we could accommodate a much higher volume of business without having to be nervous. Okay. So what we think we can do right now is comfortably warehouse about $75 million, but we could do more potentially. Like, I'm going to show you sort of the amount of unencumbered cash that we have. But we'll try to make it work. I mean, the thing with the one area, the one time of the year that kind of makes me nervous is that sometimes there is a rush at the end of the year. So I figured out I have 10 months to figure this thing out with Federal Home Loan Bank.
Okay.
Yes, Mr. Schaefer.
Tim, what happens if we have a federal debt limit impasse? Does that affect this MOU with FFB?
I don't think so, because my understanding is that the way that Federal Financing Bank price these transactions is actually budget neutral.
Okay.
So the conversation we had with the Treasury officials last week about this, they think that there's really no, yes, there is a time constraint that's part of the MOU, and it's expected that this will get renewed this September, so that it would go out to September 30th, 2020. That's the expectation. But in terms of an actual dollar, since it's budget neutral, that is not believed to be meaningful.
Thank you.
Any other questions? May I hear a motion?
Motion to approve Resolution 1710.
Ms. Sotelo made the motion.
I'll second.
Mr. Hunter? Call the roll, please.
Chair, I think it was Tim Schaefer.
Oh, I'm sorry. I thought it was Jonathan was looking at me. Mr. Schaefer made the motion. I'm sorry. Second, I mean. Will you call the roll, please?
Ms. Avila Farias,
Yes.
Mr. Schaefer,
Yes.
Ms. Gallagher,
Yes.
Ms. Gunn,
Aye.
Mr. Gunning,
Aye.
Mr. Hunter,
Yes.
Ms. Johnson Hall,
Yes.
Mr. Metcalf,
Yes.
Mr. Prince,
Yes.
Mr. Williams,
Yes.
Ms. Sotelo,
Yes?
Mr. Russell,
Aye.
Ms. Falk.
Yes.
Resolution 1710 is approved.
Okay, we'll move to item 9, which is adopting a resolution approving applications to SIDLAC for private activity bond allocations.
Before we do that resolution, I'd like to show the board. I'd like to show the board what we just did in terms of the resolutions that we passed. We could unwind all this if you guys aren't happy with what you see. So what I'm showing here is the amount of unencumbered cash, and by that I mean that unencumbered by bond indentures we have and any of the financial obligations that we have. So you can see that as of March 1st, we have about $170 million of cash unencumbered by bond indentures and financial obligations, direct financial obligations. So, so on the left-hand side of the chart, you can see that these two, this yellow and sort of a soft green, they add up to $170 million. And this emergency reserve is something that we're going to cover later today as well. So what you see on the right-hand side of the column is a stacking of all these not to exceed dollar amount that were embedded in some of the prior resolutions. You can see that the single-family lending here is $25 million, which is equal to the $5 million not to exceed for Roberti, and the $20 million for HELP and subordinate loans. And for multifamily warehousing, we did request for a not to exceed amount of $75 million. So that 75, we have explicitly set aside 50, and that the additional $25 million of warehousing capacity will come from this orange box that we have over here. So we're setting aside about $40 million to as an accordion, if you will, and it's an accordion feature to warehouse. And we also do some pre-funding of our operating budget, meaning that we have also shown the board, for example, we receive cash flow every month. And obviously, we're also paying vendors and also paying staff every month as well. But we tend not to sort of pay with cash that just came in 2 days ago. We tend to pre-fund our operating budget on a quarterly basis. So there's a need to have a liquid working capital to pre-fund budget, and also and over time, if we need it, this money could also be used for additional warehousing. And on the very top of the stack is a $15 million that we set aside for any debt management ideas that we have to continue to deleverage our balance sheet. And on the very top, I'm showing that the 170 goes to 155, because a lot of times when we do debt management, the money could, let's say, get, for lack of better word, get trapped inside a bond indenture, or that sometimes we could lose the liquidity for another form of asset, let's say a whole loan or MBS or something like that. So this gives you a sort of a high-level picture of how the previous resolutions set aside, or let's say not to exceed amounts, are play into the amount of unencumbered cash that we have.
Okay, you want to move on now to the
Yes.
private activity?
So no regrets?
I mean, I'm
Okay.
sorry, the SIDLAC.
So, so the last resolution related to financing activities is agenda item 9, which is resolution 1711. So this is a SIDLAC resolution. So what this resolution does is that the board is giving staff authority to apply to SIDLAC for a not to exceed dollar amount of private activity volume cap. So for the single family side, we're requesting $1 billion. You might recall that last year in November, we actually came back to the board for additional authority. As it turns out, that was not necessary. What CIDLAC ended up giving us was this $948 million to be used for MCC. So this year we decided to go with $1 billion, and I think, as you heard from Jury yesterday, it seems like the demand, the trajectory for demand is fairly robust. And for multifamily, we're doing something a little bit different this year. We're asking for $1 billion as well. But that's a dollar amount for all the projects that we don't separately bring to the board for authorization. So as you know, any projects that exceed $4 million, we have to bring to the board. So the idea is that things that we're bringing to the board and getting an explicit authority, those dollar amounts in the aggregate are not included in this dollar amount. And last year, we received about $190 million for conduit financings, and we did do a few lending deals that didn't require volume cap from 2016 because they used carry forward from prior years.
Okay, are there any questions? Ms. Sotelo?
I'm sorry, Tim, I didn't understand. It does not, the projects that we're going to approve do not count against the $1 billion?
That's correct.
So the $1 billion will be allocated and used for, in what context?
So there will be that will be the dollar amount used for conduits, for example, and that dollar amount could also be, I think, useful if we are requesting for carry forward for multifamily. So I think that's how this concept came up. I think this prior year was that when we were thinking about going in for carry forward for multifamily, we realized that last year we had asked for $500 million, and that when we realized that the $500 million need to subtract out all the conduits that we've done and all the things we've done, we couldn't come up with a very substantial dollar amount for carry forward request.
Oh, I see.
Does that make
okay.
sense?
So this, okay, and this ties back to what Jerry explained to us yesterday in terms of the carry forward.
That's
Okay.
correct. So we think that over time it can be powerful to have a carry forward allocation in our pocket as we sort of come to the table with all these things that we have to the developer.
Well, if anything, it helps with the marketing, right? Because we're able to go out there to Housing California and other conferences and say that this is available and we're able to do this. Okay. And I'm a huge supporter of the MCC. In my early 20s, I got an MCC that helped me buy my house, and it was just amazing. I love the program, so big fan.
MCC ADUs, we do them all.
Okay, are there any other questions? Can I have a motion to approve?
So moved, Madam Chair.
Mr. Gunning, second. Mr. Russell?
Yes.
Call the roll, please.
Ms. Abala Farias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher? Abstain. Ms. Gunn?
Aye.
Mr. Gunning?
Aye.
Mr. Hunter?
Yes.
Ms. Johnson Hall?
Yes.
Mr. Metcalf?
Yes.
Mr. Prince?
Yes.
Mr. Williams?
Yes.
Ms. Sotelo?
Yes?
Mr. Russell?
Aye.
Ms. Falk?
Yes.
Resolution 1711 has passed.
Thank you. Okay, we have one more resolution, item 10, on funding and disbursement from the emergency reserve account and rescinding resolution number 9171.
So this is a resolution this resolution is looking at a prior board resolution that hasn't been looked at for 26 years. But having said that, in the last 8 years or so, I have looked at this resolution and this account very, very hard for various reasons. And what we're trying to do here is to modernize or update the funding mechanism for this account along with the uses of this account. So just to give the board some example of why this comes up. So for example, the 91 resolution, which was itself an update of the use of this account, sized the funding of this reserve account as 1% of all the loans receivable that we have. Not only is that sort of difficult to track over time, as you can appreciate, a lot of our lending activities now is not really necessarily resulting in the loans receivable. So we feel like that aspect of it is changing. And then also that the disbursements from this account also had a number of things that are no longer relevant as well. For example, there are mentionings of hazard insurance along with our now insurance fund, which is in runoff, activities related to the insurance fund. So we feel that this is an opportunity to ask the board to consider changing the funding mechanism for this account along with the uses of this account. The funding we're recommending to be it's in some senses memorializes some of the previous presentation of how we reserve for our unencumbered cash. So we're asking that the funding to be basically 1 year of operating budget that the board approves in May. And then the disbursement is still for all the unforeseen expenditures that the agency will run across. But there is a more open provision for anything that may arise from the need to protect the agency's credit ratings or any obligations that we might have, and also the security of any the bond security of the bondholders, and along with any related financial contracts we might have. For example, let's say the swap counterparties. So there's a more open provision for allowing us to use this money to do all those things.
I just had two quick questions, Tim. One was, I was just reviewing the deployment and the folks that are authorized for that deployment of the funds. Was there any changes in that language, or is that similar to what was included before?
There's a little change there. The change is that TIA still has the ultimate authority. We are making it so that Don Kabir, our chief deputy, basically has all authority to disperse funds from this account too. And then my authority along with our comptroller's authority are the same.
That was my only question.
Oh, yes. Ms. Gunn?
Thank you. I have a couple questions. So as you mentioned, this is rescinding a 26-year-old resolution that nobody's looked at, and thank you for giving us some highlights from it. But I'd be more comfortable with this if this was also brought back on an annual or every other year basis in an effort to be transparent to the board and reaffirm these authorities. I'd also like included in here kind of an annual reporting at a high level on whether or not you've needed to use it, how you went about structuring, or what you set the reserve amount at, since it's delegated down to you. I don't know if I'm the only one feeling that way on that sort of.
Yes, I was going to ask if we approximately how much of that emergency reserve we've used.
None.
We have none?
I mean, I've stared at it very hard during the financial crisis.
Well, that's great.
I stare at the numbers and they just stay the same.
Okay. Yes. We'll let Ms. Boatman-Patterson.
So operationally, one of the reasons we wanted to bring this forward, and I guess I might have you and Don speak to this, was to do some cleanup and allow us the flexibility to operationally be able to effectuate business that emergencies that may come up. Is bringing this resolution back on an annual basis, does that distract from some of that flexibility, or is that?
I think it could be okay if that's what the board wishes. I mean, we could also potentially add a reporting requirement. So if the board wishes, we can bring this back as this sort of bundling of resolutions that we present in March to give the board an update of whether or not we use the emergency reserve account and then refresh the authority to fund it and to use it. The one element that could tie well with this idea is that we do expect the funding of the emergency reserve to change on the margin from year to year, because that's basically sized at the operating budget rounded to the $1 million. So there will be a sort of like a funding mechanism that's happening that changes every year. So if the board desires, we could bring it back as this bundle, and that once the board passes the resolution, passes the business plan, the budget in May, we would go about funding it at that approved budget level later in May or June.
Madam Chair.
Yes, Mr. Schaefer?
I guess that's begging the question. It seems to me that there's a very appropriate interaction between the budget and the actual experience on this, so I guess I'm going to ask the obvious question. Why wouldn't we just consider the report at the same time we're considering the budget, rather than to consider the resolution, which is the enabling mechanism? Is there any merit to doing it that way?
To doing it now rather than when we consider the budget?
Yeah.
In
Yeah.
the next board meeting?
That's okay with me too. I mean, I think that it sounds like definitely there's a desire for reporting, and we can definitely do that, no problem. As the board knows, there are various elements of reports that we do. We do an investment report as well to the board that tend to come in that November, January board meeting, and we could do this report as, I think that the best time to do this report is probably May.
Okay.
I
Here,
would-
Ms. Sotelo?
I would agree that maybe we table this resolution until we bring it back in May, and then have that mechanism in there where we report and establish the reserve at the time that we're approving the budget.
Are we doing the budget in May?
Yeah,
That's-
business plan,
that's
budget in
when we do
May,
it?
yeah.
Uh-huh.
So I mean, I think that
Would that be
the what we're saying here is that we would, the resolution doesn't speak to a specific dollar amount. It just says that it's 100% of the budget that the
So
board
adopt the
approves.
Yeah.
So in theory, that the dollar amount need not be determined today.
Yeah, I was just going to suggest possibly that we could include this as a portion of the budget resolution itself. So it could just be a section within the budget resolution. That might be a possibility as well.
That's a good, yes, solution. Mr. Schaefer?
Yeah, I don't want to try to micromanage this. I leave that to you. But it seems to me that the appropriate place to do the resolution is at the same time we do all of the other borrowing resolutions. And perhaps I wasn't clear in my communication. It seems instead that the report that the board seems to be leaning toward would be more appropriate to align with the budget. The adoption of the resolution to be kept with the adoption of all the other resolutions, but then the requested report would become part of the budget process. Am I disconnecting that in some inappropriate way?
I like that, actually. I'm assuming you're asking for my opinion.
I was.
I like that better, because I find that what we're doing here is simply giving a reserve requirement without an actual dollar amount. The dollar amount would actually be funded later. And I find that the May agenda tends to be extremely long, and that's part of the reason why these resolutions come before. But having said that, these resolutions are the very reasons why I'm usually the bad person who is making people set up all those business planning meetings in January. Because I tell them that, I tell everyone that's involved that I need these resolutions in March, and we need to be able to know what we're going to present in May for approval so that it could be included in March. It's just our way to manage what the board needs to do in May and also March.
Well, that's the best reason yet, so maybe we should just stick with that. We ready for motion, Mr. Russell?
Yes, I would move Resolution 17-12 with the additional direction that staff report back on the status of that reserve as part of the budget deliberations annually.
Okay. A second from Mr. Gunning. Would you call a roll, please?
Ms. Abala Farias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Aye.
Mr. Gunning?
Aye.
Mr. Hunter?
Yes.
Ms. Johnson Hall?
Yes.
Mr. Metcalf?
Yes.
Mr. Prince?
Yes.
Mr. Williams?
Yes.
Ms. Sotelo?
Yes?
Mr. Russell?
Aye.
Ms. Falk?
Yes.
Resolution 1712 is passed.
Thank you very much. Thank you, Mr. Sue, and I want to thank the staff for having made the procedure to bring this to us every year, annually, because I think it's really important, and so it's great that we're doing this. So item 11 is if there's any last words that people want to say based on our discussion last night. There will be certainly many opportunities going forward to discuss these specific items as they come forward. Ms. Boatman-Patterson?
Yes. It would be nice if Preston can give us a little bit about what the housing authorities are doing in the face of some of the budget cuts. You mentioned it earlier, but now might be a good time to kind of just outline as we go forward and we're looking at how we're running our programs or underwriting our programs that are accepting Section 8 or project-based section vouchers. And you and Ms. Sotelo both mentioned a transitional operating reserve set aside to protect tenants in case of a loss of federal funding. So I did want to hear perhaps a word or two on what Fresno Housing Authority is doing.
Okay, so this conversation really started when sequestration was adopted a couple of years ago, and as people know, sequestration is like the 10-year process to ratchet down federal dollars. Ben, you can explain it much better than that. It is on hiatus, though it is still active and may come back. But a few years ago, as housing authorities looked at the impact of sequestration and we were getting fewer dollars, housing authorities in California, I'll talk about primarily, started looking at what the impact was going to be and started adopting housing policies, either increasing housing standards, meaning more people per bedroom, or reducing payment standards, lowering down the portion of rent that the Section 8 was going to pay, and then having to look at termination policies. And I think throughout California, people are looking at, is it first on, first off, last on, first off, highest HAP, first off, lowest HAP, first off, and so. So the conversation, I think it's settled down a little bit, though the high cost areas have always been really struggling, I think, in California with both the utilization of HAP. So I don't know San Diego's rate, but San Mateo, for example, only about 8% of the families that are issued a voucher are able to lease up. That's the extreme number. I think in San Diego, which is another very difficult market, it might be in the 30 or 40% range. I've heard the number, but I can't quite remember. So we've always, as housing authorities, been struggling with the lease up of housing choice vouchers and those high cost area, the tight rental markets. So what I hear happening right now in California, and I did send Tia a message that maybe invite, Ken Cole or from San Mateo or Michelle from Sacramento to the next board meeting to kind of talk about things. But there's an article I did send to her where Ed Mayer in Butte, so in Chico, just because of the 5% cut that we received in, although we got a continuing resolution for 2017, we actually got a 5% cut in our HAP dollars, and Butte is looking at terminating 300 families from the program as a result of that. So that is what's happening. I think that the policies that I'm not quite sure about are like, the project-based vouchers are probably pretty protected. So those developments that have a project-based voucher have some protection, because I imagine those families are not going to get terminated, right? Because there's a long-term contract. But what you're really talking about is the lease-up of new vouchers. Fresno's numbers are pretty astounding. We had 65,000 applicants on our wait list. We closed the wait list, and then we cleared it as we're going through a technology software change, but we're going to reopen our wait list. I assume we're going to get 65,000 applicants again for the 13,000 vouchers we have. So the demand is pretty high. What I'm seeing throughout California is just a huge reduction. People are stopping the lease up of vouchers and then talking about termination of families. So it is a pretty scary thing. So that's on the housing choice voucher side. On the public housing side, we are getting about 90% of what we need to operate our public housing. The proposal is to cut capital funds. So a lot more of us are going to be coming to see Mr. Stivers to try to figure out how to refinance our property so we can do the backlog of repairs that we have. So it's pretty dramatic, and when I look at what's happening in the housing authorities. That's in a nutshell. We do have our housing authority, CAHA, the California Association of Housing Authorities, has their legislative piece that's been finalized. We go back to DC in 2 weeks, week and a half. Again, I can ask that to be sent to Tia and distributed. So that's something that's put together. The two authors are Chris Guig out of Alameda County and Ana Gamiz from San Bernardino, but there's a lot of people who work on it. But that does have a little bit of a story of the impact that's happening in California, and then some of our requests that we have. And just so people know, my board in Fresno, we debated the termination process. So right now we're okay in terms of our program and our funding. I think it has everything to do with our housing costs just isn't the same as other places. And so we're able to maintain 100% utilization or 99% utilization rate right now. But my board went through long conversations and decided to adopt a random lottery for termination which might seem the easiest route out, but they just decided that it's kind of, unfortunate families have to be terminated. So I think they do, we protect seniors and people with disabilities, but other than that, it's just a random drawing if we terminate. I don't know what the other termination policies that people have.
Ms. Boatman-Patterson?
So do you have any thoughts or comments on parameters or policies around transitional operating reserves for our developments that are receiving tenant-based rental assistance?
Yeah, so I used to hate them when I started doing development right at the Seattle Housing Authority back in the 90s, because it just added a lot of cost to the development, and it seemed then that the housing choice voucher was the program funding was pretty stable. So we always argued against it when I was at the Seattle Housing Authority. For the most part, they went away, and then it came back after the recession in 2007, 2008. So they're coming back to developments where investors are asking for reserves of housing authorities for that transition. So to me, it kind of makes sense. I mean, if we're able to finance it and put it into the project and take care of the families, again, I said this earlier, in Fresno, we do have a trigger that allows the funds to be released to the housing authority after a period of time. I'm not so sure if others can handle that kind of financial impact, but it kind of makes sense to me.
And so are you setting aside 12 months?
No, it's more like 5 years or something like that. It's multiple years. But I can get that exact number and send it out.
Okay.
Mr. Metcalf?
Yeah, so just for point of reference here, HCD's current policy is 2 years of transition reserves which are sized based on what the incomes would be on average of the tenants if the subsidy went on up to the expenses of the properties. But the conceit there is after a period of 2 years, you have transitioned those households out and moved new households in that are probably at a higher median income so that the project can continue to pro forma. So be clear
Yeah,
on
so
that.
2 years is, I'm sorry, the period of transition is 2 years. I'm sorry, I misunderstood. It's like after about 5 years that the funds come back to us. But yes, it's a 2-year transition that is being
Okay.
looked at.
And then, the other thing, obviously, that's been very helpful here is that we now see all of our PBV contracts at a 15 plus 15 for a functional 30-year term. So that has helped a lot and helped a lot in the industry because in all likelihood, you are going to a refinance or resyndication at some point during that 30-year term. And so this issue is going to become more and more pronounced, I think, as we come across those contract terms where you don't have the full runway of the 15 or the 30 or at the minimum the 15 as you're going into a resyndication. I think the issue could continue to be out there.
And I think that the other big fear that's out there is that there is talk about block granting housing choice voucher again. And so once it becomes a block grant, does it come to the state? And then how is it distributed? It's a very confusing idea. And what we have seen with block granting, again, Ben, as a old HUD person, relatively young old HUD person, saw that, block granting has really deep cuts over time. So Indian Housing was block granted about 20 years ago. I can't remember exactly when. And what we've seen with funding for Indian Housing has been a pretty stagnant, if not a decline. I think it's a pretty big decline. So there is fear that if housing choice voucher becomes block granted, we're going to see cuts coming. And just so people know, I think California gets about 12% of the housing choice voucher budget on an annual basis. So we definitely are a large part of the HUD funding for the Section 8 program nationally.
Thank you. Ms. Sotelo?
To me, it becomes a policy issue in terms of, our underwriting criteria for our program. We certainly want to encourage developers to use our permanent loan program, but we also want to make sure that, the residents also are beneficiary of the government funding that we're passing through to the developers that they use in that program. So, when we talk about sizing of the reserve, there is a difference between sizing a transitional reserve that's a project-based, reserve, or a project-based Section 8 contract versus something that what we saw today in Carlsbad, which was more of a tenant-based Section 8. So I think that from an underwriting standpoint, we do need to look at those two differently. And I would support the idea of having that transitional reserve burn off and be reinvested back into the project or, redistributed part of cash flow to debt service, the subordinate debt, or to, be distributed to the developer. I think that a 5-year hold is a pretty good number, a pretty good time amount, but we've got to underwrite it to make sure that, it's in line during the period that we anticipate the project-based vouchers burning off altogether, right? So it's got to carry a transition, and then it's got to burn off once all those tenants actually leave. So it's kind of the earlier of when all the tenants are transitioned out, or a 5-year period. And I think from a sizing standpoint, the way I've seen it successfully done is to underwrite to break even and not to underwrite to the fair market rents that you're receiving under the contract. That way, it's a smaller transitional reserve, but it's more realistic because you're actually just, operating the units at break even as opposed to measuring them against the market rate increase that will happen over time.
Just Preston
Prince?
Prince again. I'm sorry.
Okay.
So I also, just for clarification, the majority of vouchers are really under the multifamily program and the project-based and the PBRA, the project-based rental assistance program. So new construction, Section 8, or the old mod rehab. I think there's 1.8 million units in that. So there's only 1.2 million housing choice vouchers that go to housing authorities. So the bulk of or the majority is with the private owners, for the most part, private owners. I totally agree with you, Delilah, of looking at underwriting. So we do run, we underwrite to the lower dollar amount, and then if we think we're going to be getting housing choice voucher funding, then we look at that for a period of time, either to help fund a tranche B or something like that, that we take a little bit of risk on. But I think we should, most of us developers should be looking at what happens if someone goes away and what's that lower rent, as opposed to assuming that there might be a Section 8 windfall, I don't know the right word, additional dollars coming in. So I do think that that's something to look at.
Thank you. Any other questions or comments, rather? Okay, item 12 are the reports from staff. If we typically only discuss them if somebody has questions.
Yeah, and I do have to go, so you do
Mr.
have a
Prince?
quorum, right?
Yes, and we're pretty much done.
We're opening libraries at some of our properties today. So exciting.
Okay, any other, item 13, any other board matters?
So I was provided with the dates of the annual conference for NCSHA during the break. And so our annual conference will be held October 14th through 17th, and that'll be in Denver. And the Housing Credit Conference will be in Atlanta, Georgia, June 20th through 23rd.
Thank you. Is there any public testimony? Item 14. I have okay, item 15, could I have a movement for adjournment? Motion, Mr. Russell? Okay, I don't know that we have to vote on it, so the meeting is adjourned.
Thank you.